Good morning. Hello, everyone. Welcome to today's webinar, Making Tax Digital, the Past, the Present and the Future. I suppose less of a Christmas carol at this time of year and more of an Easter one. I can promise you there'll be no ghosts of MTD past in this tale, but perhaps a few spectres would be more appropriate. Her Majesty's Spectre of Taxes, maybe. If you have any questions as I go through the presentation today, please do not hesitate to post them into the Q&A panel that you should be able to access on your console. I'll keep my eye on that throughout and try and address as many questions as we go along. If there's any that I don't manage to cover during webinar, then I'll distribute answers to those afterwards. You'll also notice that there is a chat facility. I won't be monitoring that one, but do feel free to chat amongst yourselves, have conversations, ask each other questions as you see fit throughout the presentation. As I say, if you want to interact with me, then do post any questions you like into that Q&A panel. So that's me on screen. Very much an accountant in practice still, been with Wolters Kluwer for the past 3 years working on technology solutions, but I think accountancy will always be, or an accountant will always be who I see myself as. So what can you expect to learn from today's session? Well, I promise to bring you and your teams up to speed on where HMRC are with their Making Tax Digital program. That's across all taxes. What strategies that you should be implementing with your clients today. And of course, how Wolters Kluwer are innovating for the future to ensure that your practice stays ahead of the competition. So where are we on that HMRC timeline? Well, if you recall, it all began back in 2015 when the then Chancellor of the Exchequer, George Osborne, announced with great fanfare government plans to modernise the tax system, bringing it into the digital age. He signalled the death of the annual tax return as we know it, and hailed the scheme as revolutionary simplification of tax collection. Later in 2015, David Hawke, the Financial Secretary to the Treasury, published the government's vision for transforming HMRC into one of the most digitally advanced tax administrations in the world, and thus Making Tax Digital was born. Now, I've got no problem with any of the aims or goals of the government, or indeed HMRC. Revolutionary simplification of tax collection, transforming HMRC into one of the most digitally advanced tax administrations in the world. I would love our tax regime to be simpler. I would really love HMRC to be digitally advanced. I think at this point, even just digitally average would be an improvement. If I were to assess HMRC under their own criteria, I may very well consider them to be digitally excluded and unable to operate digitally without third-party assistance, but that view is purely my own. I am yet to be convinced that the current strategy for making tax digital is going to get us to that nirvana. If we do get there, if providing tax services does become simpler, then I cannot help but think that it was perhaps less to do with the strategy and more to do with the technological innovation from companies such as Wolters Kluwer that have been required to deliver solutions for that strategy. I read a great article the other day by Helen Thornley in Accountancy Today, and she was talking about the digital tax system in Finland and how for many taxpayers it's simply not a case of completing a blank tax return every year. The tax return itself becomes pre-populated with all the figures, and the taxpayer merely has to verify those figures are correct rather than compile and enter them. Interestingly, those pre-populated figures do not include business or property income. Finland, like many digitally advanced tax administrations, chose to start with obtaining data directly from institutions and corporate bodies with the capability of providing such information in real time, whether that's banks, brokers, investment managers, employers, indeed the companies, reporting their own dividends themselves into that tax administration as and when they happen. I am still unsure why our administration chose to forego that route and attempt to tackle the most complex, perhaps even unreliable subset of data that would go into a taxpayer's return. However, that repopulation of tax return data really resonated with me for a couple of reasons. Firstly, as a global supplier of tax solutions, I'm quite privileged at Wolters Kluwer to be able to gain insight into the solutions that we build to solve tax problems in other countries around the world. So we do get to see some foresight into what our tax system might look like in future. Secondly, that pre-population of data from wherever we can obtain it, that really underpins our forthcoming suite of cloud compliance applications, that data-driven approach, whereby our customers, accountants in practice, no longer have to start with a blank tax return. It will be pre-populated with data that we're able to obtain in real time on behalf of the accountant. But coming back to HMRC's timeline, so things get a little bit hazy for me between 2015 and 2019, not through any personal lifestyle choices, but more so that I'm probably still feeling a little bit battle weary from the journey we went on with our customers, with HMRC through that whole MTD education piece. What can we do? What can't we do? The moving go live dates, putting select clients into the pilot scheme, seeing how's that worked. I do feel that I may have blocked out some of that pain because I don't feel quite so apprehensive about tackling income tax, perhaps because of some of the things that we learned along the way with VAT. But make no mistake, this is a big project to undertake compared with what was required to make VAT digital. It's a really different ballgame. That was 2 years ago. A lot has obviously happened in the world since 2019. So what's the next pertinent date on the MTD calendar? Well, 1st of April 21, that marks the end of the so-called soft landing period for digital links. There'll be no more copy and pasting figures into a VAT return, and certainly no more manually entering them in. Now, for anyone that uses our MTD for VAT bridging solution within CCH OneClick, we're never actually allowed manual entry or copy and paste. We are aware that other providers release that functionality from the outset. And actually we understand from many of those that they will continue to allow that. And the onus is really on the end clients, the accountants, the users of those applications to make sure they're doing things correctly. So I would urge you to check that all members of your team undertaking VAT work understand the implication of the end of the soft landing period, and just make sure that any processes they're going through, any clients where perhaps they have been doing a bit of copy and pasting, a bit of manual entry, that they look and make sure that either they're not doing that and all that data is digitally linked, or that they're only doing it in the scenarios that you're allowed to do so. If you're making adjustments to those VAT figures before they go to HMRC, that you can't actually get into the underlying bookkeeping application itself, those are still acceptable. Now, one additional item on the not allowed from April 21, in fact 8th of April 21, is the electronic filing of non-MTD VAT returns using third-party software products. Your only option for those clients is to either voluntarily bring them within the MTD regime, where hopefully you can continue filing using the software that you have been before, albeit using their MTD functionality, or you will have to go back to HMRC's website and manually enter the VAT figures, which does feel a little bit of a backward step there. I think much head scratching has taken place as to why HMRC have withdrawn that ability for third-party software suppliers a year in advance of our next pertinent date. I suspect it was probably less by design and more an unfortunate consequence of the various delays to the MTD for that rollout, meaning that certain milestones have now become misaligned. Now, it may have made more sense to align that withdrawal with our next pertinent date, 1st of April 2022. Now, this is the date from which all VAT registered entities will fall under MTD and cause the switching off of HMRC's website filing service. This really marks the final step in that 7-year journey from 2015 to 2022, and the end of the MTD transition for as far as VAT is concerned. I do wonder if from that date we can all stop referring to MTD for VAT at all and simply go back to calling it VAT. I guess time will probably tell on that one. So the most important date on this timeline from my perspective, and perhaps yours too, is April 23, the date from which the first tranche of MTD for income tax self-assessment taxpayers, that's a bit of a mouthful. I tend to still use MTD for income tax. I tend to drop the self-assessment bit. I'm pleased HMRC have not dropped it, because it isn't completely separate regime altogether. It's just a different mechanism. It's still very much a self-assessment. I can't force myself to call it MTD for ITSA, which I'm hearing more prevalently and more frequently. So for me, I'm going to carry on saying MTD for income tax. It is the biggest change to our tax system since the inception of self-assessment for those of you that remember those heady days and the transition from the prior year basis of taxation to the current year. So it's I would say even bigger transition that we saw then. We'll see with MTD for income tax. Before we do a deep dive into that, I think worthy of a mention is the final date that we've got there. The government have stated that MTD for corporation tax will not take place before 2026. My own feeling is that whenever the government announce a date as not being before, they actually mean a considerable time thereafter. I think to see MTD for corporation tax mandatory from April 26 would require the rollout of MTD for income tax to be far smoother than perhaps anyone's really anticipating right now. So it could happen, but I wouldn't be hedging my bets on that one. Indeed, the criticisms of the MTD regime continue to pour in from within and without the profession. The response of my own governing body, the Chartered Institute of Taxation, to the open consultation on MTD for corporation tax is unsurprisingly somewhat critical, but I think very sensible, very worthy of a read. They make some very valid recommendations that actually hadn't struck me as an obvious route to take, but I think very valid, not least that if a company already falls within the MTD for that regime, and so therefore already compelled to be keeping digital records, using functional compatible software, and providing HMRC with quarterly summary updates, then what really is there to be gained from compelling that same entity to submit a variation of the same data, albeit perhaps not necessarily on the same quarterly stagger, but they are already doing those things. They're already reporting under MTD for that. The TIOT suggests that entities already within the MTD for VAT regime should therefore be excluded from any additional reporting under MTD for corporation tax, as the gains from HMRC's perspective, that reducing the tax gap by improving the record keeping of businesses, there should be no marginal gain by reporting under the same data effectively under two regimes. As good a suggestion as that is, I'm not convinced HMRC will grasp the logic behind that suggestion, so I'd be quite surprised if that's taken on board, but I do fully support any narrowing of that wide pool of entities joining MTD from the outset, whether that was VAT, income tax, or corporation tax. We do have a question come in, particularly about that kind of digital links and the filing. So let's have a quick see if I can cover off that one before we move on to the next step. So this is about business bookkeeping software, recording those transactions digitally. Current process is to export into Excel a summary of those transactions, and then presumably using bridging software to submit just those summary totals to HMRC. Does that constitute a breaking of the digital link? No, I do not believe it does at all. If you're exporting any kind of report from underlying software solution, and then, for example, if you're using our software, then uploading that summary spreadsheet totals into the software for onward submission to HMRC, then there's no break of the digital link there. Using multiple applications to achieve the submission is absolutely fine. That doesn't constitute the breaking of a digital link. Okay, so let's take a little look from an MTD for income tax perspective, who is in and who is out from day one. Well, individuals and partnerships are in, trusts and incorporated entities are out. We know that companies are not out completely. They do, of course, get a stay of execution at least until 2026. But indications are that trusts may well be out permanently. We've had early sight of the draft legislation around MTD. I have to say, very early and very draft. It is quite incomplete in many areas, but it does state that trusts, estates, trustees of registered pension schemes and non-resident companies will not be required to join MTD for income tax. There is a tone of finality in the legislation that suggests that it could well be a permanent move. Only time will tell on that one, but I think it's certainly off the foreseeable roadmap as far as MTD is concerned. The draft legislation also defers certain partnerships to an as yet unknown future date. So LLPs, as you might expect, limited partnerships, they're not very common, and also partnerships with corporate partners. So let's assume you are not one of those excluded or deferred cases. Which of those are in and which of those are out? I've had a question come in. We'll just be providing an MTD submission style for income tax similar to MTD for VAT. Thanks for that question. I shall cover that a little bit later in the presentation. So hopefully I have some good news for you there. So who's in? Well, it's individuals and partnerships with either trading income or property income or both, whose turnover, not profit, exceeds £10,000 per annum. It's the combined turnover from both trade and property, if you have clients with both types of income, and I'm sure you do. If you are a partnership, it is our understanding that it will be the individual's share in the partnership revenue that is used to determine that £10,000 threshold. And I'm sure we can all come up with a variety of complications around what may or may not constitute an individual's share of partnership turnover. So perhaps best not to ponder too long on those permutations until we see a little more guidance or indication in the legislation of how that will be measured. The draft legislation is currently silent on that matter. Now, you may be wondering at what point you take that £10,000 measure. It does not operate in the same way as the VAT threshold, for instance. You actually look back 2 tax years prior to determine whether your trade or property turnover exceeded £10,000. Yes, had a question come in. Do you add together trade and property in determining? Yes, absolutely. So they're not looked at in isolation. It's not if a trade or property revenues in a year independently exceed £10,000. It's the combination. So look at your client's total revenue from trade and property income. So you could very well have clients that have small trading income, small property income, that will, as a consequence of them added together, fall under the MTD for income tax regime. So yes, you've got to look back 2 years from the starting point to determine whether you are going to fall within MTD or not. So for example, if you were in that first tranche of HMRC customers invited to join from your accounting period commencing 6th of April 23 and therefore ending 5th of April 24, you must look at your tax return, not the accounts, your tax return for the year ended 5th of April 22 to determine whether you exceeded the £10,000 threshold or not. I think looking at the overall reported figures on the tax return rather than going 2 accounting periods back probably sidesteps the issue of whether you've got a trade and property but non-coterminous year ends. Your property is going to have a 5th of April year end, your trade could have any one of a number of year ends. It's probably a way to simplify that and give people an easy way from their tax return to determine whether they should fall within MTD for income tax regime or not. If you didn't have any accounts, we didn't have any income from trade or property in the 2 years prior, or should I say if you were not trading, you didn't have any property that you're renting out, then your turnover for MTD purposes is determined to be nil. Therefore, for new businesses or newly rented out properties, you do have 2 years grace before you need to start filing quarterly updates under the MTD regime. So, armed with this knowledge of who amongst your current client base may potentially fall within MTD from April 23, what are you going to do with that information? Well, firstly, you should identify exactly who in your client base is affected. I think whenever I talk to, or whenever I ask practices to give me an estimate of the proportion of their clients that they think will form part of that initial tranche in April 23, I do get some people suggesting 20% of their client base. I get many more estimating 60 to 80% of their client base. Some forward-thinking practices can tell me the exact percentage, and they can do that because they have profiled their client base. We have had another question come in. If in year -2 you were over and year -1 you were under, do you need to join? Yes, you do, because in year -2 that's the pertinent year. Now in your next year, and you look back 2 years again, the suggestion is that you could then come out, because each year you're looking back 2 previous years. Now, again, the draft legislation isn't particularly clear on that scenario. My instinct is that once you are in, you are in, and you will be permanently in, a little bit like VAT, where we have different registration thresholds, deregistration thresholds for different VAT schemes. So it's my feeling that they will do that. It's not been set in stone, so don't take that as gospel. But yeah, at this stage we don't know for sure. We've got a question from Nigel. Is there a point of time where the 10,000 threshold is to be removed? And what happens when your turnover exceeds it but then falls below it? So I think I probably answered the latter one there. It's unclear at the moment. My suspicion is that once you're in, you're in, but it may be that that effectively a deregistration threshold is allowed and you can come out of MTD. But will it be removed at some point in the future? I think almost certainly. For me personally, I think I would have liked to have seen that threshold start much higher. I think it just would have been sensible, in spite of what the Chartered Institute of Taxation have suggested, which actually I quite like. But you know, why not align it with the VAT threshold? That £10,000 is going to catch a lot of people, and it would just seem sensible to start with a smaller subset to me. But 10,000 is where we're at now. That may change the closer we get to April 23. And I think, yes, the intention will be at some point in the future, the threshold will probably disappear, but I think I don't think dates have been set for that. And I think that will probably be dependent on how successful or not MTD is at that point in time. So I think that's probably something that will be monitored. Will there be a report in CCH to run a check on the thresholds? Yes, I say there will be, there is. On to that point. So the clients of, or the customers of ours that can tell me the exact percentage, it's because they run those reports on their database. Based on last year's tax return rather than you know, the most important date, which will be this year coming, the April 22 date, that's the one that's really pertinent. Based on last year's tax return, you can, within CCH Central, run a report to identify sole traders or partners in partnerships above those turnover thresholds, to help you identify those. If you are a current customer, there is a knowledge base article to show you how to do that, and that's already in your system today. We first put it in, I think, a couple of years ago. So in the knowledge base article, it tells you how to change the parameters to give you that report for the last tax year just gone. So another thing you can do once you've got that list, you've identified that list of exactly which clients are likely to be affected and come in from April 23. Then those clients, you should tag them with an MTD badge to indicate that they're on a journey to becoming MTD ready for April 23, because whether they like it or not, that journey begins now. In our software, some of our customers use extra fields, if you're familiar with that, in CCH Central to badge characteristics of clients for all kinds of things. Personally, I would probably use a CRM system, a bit more flexibility. We do integrate with some good CRM systems. Couple more questions have come in thick and fast. It's excellent. Digital exclusion for MTD. Yes, we'll cover that shortly. What happens with clients who are, say, retired but have a large investment portfolio, so they have no trade or property income? Do they come into MTD? No, they don't come under MTD. It's just trade and property. So because they don't come under MTD, they carry on filing under what we're now calling legacy self-assessment system. That is going to continue for many years, I'm sure. So they continue as normal if they're not caught under MTD. Now you've profiled your clients, you've got your intake of MTD recruits all badged up and ready to go. You really need to segment or profile those clients a little bit more, so you can find the most appropriate pathway for them to graduate from being an MTD recruit to being MTD ready. And of course, there's no harm in them becoming MTD ready well ahead of April 23 if you can fast track them along the right pathway for them. So the sooner you commence that process, the better. And I'm sure you will have been putting many of your clients on such a digital journey anyway. So how are you going to segment that list of clients? What are the factors or circumstances that will affect their journey to becoming MTD ready? Well, the starting point for me is always the bookkeeping, right? Remember that the key requirement under MTD is capturing transactions digitally in record-keeping software as near to real time as possible. So some of your clients are not capturing transactions digitally. Some of your clients are not capturing transactions at all. And why should they? They've got you to do that once a year in January, and I'm sure they're paying you handsomely for that privilege. That won't cut the mustard from April 23. I would say those clients are your highest risk from a compliance perspective, and their pathway to MTD enlightenment might be the most arduous. At the other end of the scale, you might have clients who are already capturing transactions digitally, perhaps in a cloud bookkeeping application, such as our highly rated solution, Twinfield. All their invoices, receipts, expenses might be captured digitally in a data capture application, such as that very highly rated solution, Basecone. Wolters Kluwer as an organisation, we're approved by the Financial Conduct Authority for using live transactional bank feed data. That too may already be flowing seamlessly into your client's bookkeeping application in real time. Perhaps with these clients, you're already monitoring their financial performance monthly or quarterly. You might be presenting this information to them in an easy to understand visual way. You might use tools like FinSit, a very highly rated financial insights tool that's used to drive meaningful conversations with your clients. Those clients are probably already MTD ready. And for them, submitting quarterly updates to HMRC will probably be done at the click of a button. Question coming about Excel. Is Excel permitted for clients to use? Absolutely. I'll cover Excel shortly as well. Thank you for reminding me. But either end of the scale, you're going to have clients somewhere in between, and they too will need segmenting or profiling. So now you've segmented or profiled your clients into various groups, how are you going to determine what pathway is the most appropriate for each group? That's going to be somewhat dependent on what solutions are going to be available for you to support those clients from April 23. But I think before we go into those solutions and spreadsheet one of those, let's have a look at two pathways that you should probably consider exploiting before you start looking into the solution space. And that's the exclusion pathway and the deferral pathway. Now, I mentioned a few exclusions earlier: trusts, estates, trustees of registered pension schemes, non-resident companies. Not much pathway opportunity there. I wouldn't necessarily be recommending putting your clients' property portfolios into trust just to avoid MTD. But there is potentially the digitally excluded pathway. We had that earlier. I think you should explore that for some of your clients. So this is defined as those who cannot engage with accounting software for reasons of religion, disability, age, remoteness of location, or any other justifiable reason. I don't have examples of justifiable reasons, but if anybody does have examples, do please feel free to share those amongst yourselves in the chat box. These will be considered on a case-by-case basis by HMRC. Now, if you have successfully argued that any of your clients should be exempt from MTD for VAT, because they are digitally excluded, then that decision should automatically flow through MTD for income tax as well. It's not HMRC's intention for a separate application to be made for the same individual. Now, this all came about as part of a HMRC research study that was undertaken back in 2015, and the outcome of which suggested that 15% of the population would be considered digitally excluded, which to me sounds like a target to go for. 15%, great, that's anything above that's a win. Unfortunately, they repeated that research last year, and HMRC are now stating that only 8% of the population should be considered digitally excluded, perhaps as a result of the greater prevalence of digital interactions that we've been undertaking as a society since the pandemic first took hold. Either way, I have heard stories of some accountants who have managed to persuade or agree with HMRC that more than 50% of their otherwise MTD for VAT clients are indeed digitally excluded, and are anticipating similar results for income tax as well, for those that are not already excluded because of VAT. I've got no reason to question the honesty or integrity of those practices, so if your clients do have a genuine case, then you should take the appropriate steps to identify them, have that status confirmed with HMRC, and of course give them a digital exclusion badge in your profiling job. A couple of questions about Excel spreadsheet solutions. Obviously a popular topic. It would be a huge upheaval to be moving people off of Excel spreadsheets into something else. So I promise you I will come to that very shortly. Now, we talked about exclusions. You may have more success still with a deferral pathway. There does appear to be some opportunities worth exploring whereby you could delay the point at which your clients need to enter the MTD regime and start filing those quarterly updates. First of which revolves around the accounting period end date. I'm conscious I've been talking quite a lot about this one, and I'm also conscious that HMRC do attend some of our presentations, so I'm hoping that this one doesn't get legislated against in some way. But as things stand, if you recall, MTD begins for accounting periods commencing on or after 6th of April 23. So it's not for a specific tax year, it's for a specific accounting period. So all your 5th of April 24 year ends will be caught. Your 31st of March 24 year ends will not be caught, because their first accounting period to commence on or after 6th of April 23 is actually their accounting period for the year ending March 25. So simple year-end change, which, you know, from 5th of April to 31st of March is probably going to have a little impact on basis periods over that relief, will potentially, as things stand, buy you and your clients an extra 12 months. You can only use that for sole traders. I think there is something in there to prevent partnerships. I'd have to double check. There is certainly something in the draft legislation to prevent you trying to change the accounting period end for a property business. Property business, of course, have to report on the tax return to 5th of April, but strictly speaking, don't have to have an accounting period to 5th of April. But that's specifically been legislated for in the draft legislation. Now, they could, between the draft and the final, do something similar for sole traders as well. But I'm just not convinced they will. I think they had to draw the line in the sand somewhere. They could have made it for the tax return, but I think they didn't want to be pulling in all those 30th of April year ends in really ahead of the tax year. So, you know, I kind of think they've drawn the line in the sand, and that gives us an opportunity. Incorporation, we're always looking for a good reason to incorporate our clients, right? I think perhaps the heyday of incorporating everyone left, right and centre to take a slice of the generous tax savings has perhaps somewhat dried up in recent years, but you know, getting a 3-year pass on MTD, minimum 3-year pass by moving a sole trader into a company or a partnership to an LLP, that's really got to be a factor worth considering. One of many factors around incorporation, of course, but I think it will be a deciding one for some clients, particularly those on the cusp of incorporating or not. So again, you've got a segment of clients that you can defer, badge them up, worry about the rest. What about the rest? What about everybody else? We've done all the excluding and deferring that we can. We've exhausted those opportunities. What pathways do we have available for those? We're going into MTD from April 23. Well, let's start with the obvious ones. Cloud bookkeeping solutions. Are the cloud bookkeeping solutions your clients using going to be providing you and your clients with the ability to file quarterly MTD updates within the product? Maybe, maybe not. You would think that the big names in the bookkeeping world will have solutions ready and waiting for you come April 23, but I don't yet see any of them on HMRC's list of approved income tax software. Let's face it, not all bookkeeping solutions are appropriate for all clients, otherwise they'd be using them already. I was on a call with a customer yesterday who suggested they have a list of 150 plus different bookkeeping applications that are used across their client base. They don't recommend all those applications, but if a new client comes on board and they're using some bookkeeping application that they've happily been using for years, even if it's not particularly great from the accountant's perspective, you know what, if they know how to use it and we can get the information out of it, then I'm happy with the status quo. So I'm sure there will be hundreds of bookkeeping applications that will not be providing this for you. You've got clients that are on cloud bookkeeping and it's the right move for them, badge them up, let's get them on the bookkeeping pathway. Take one step back in the evolution of client record keeping. I know a few people have been asking questions about this, spreadsheets. So HMRC were forced to concede in the lead up to MTD for VAT that spreadsheets are and will continue to remain an acceptable form of digital record keeping. I do not see any movement in that at all. I don't see, I don't hear of any rhetoric from HMRC that they're going to question that. I think that's just been accepted now. So just as that's acceptable for MTD for VAT, it's acceptable for MTD for income tax and eventually corporation tax. Now, I'm sure many of you will have a substantial number of clients who currently use spreadsheets. Some of you may be able to move those onto something a little more robust. Some of those you might already identified as, you know what, let's get them on that cloud bookkeeping pathway. MTD can be the driver to get them on there, even if they're not quite buying into the benefits. You know there are benefits for both them and you. This could be just that little extra push that they need. Others, you are probably just happy after many years of training, they have finally got to a reasonable standard of bookkeeping using a spreadsheet, and neither you nor they wish to go through the pain of teaching them how to use a bookkeeping application. For them, maybe the right pathway is staying on spreadsheets, but perhaps getting into a pattern of updating them more regularly. Or perhaps they don't really do anything in the way of record keeping at the moment, and I'm particularly looking at your property landlord clients here. Maybe just getting them onto a spreadsheet is a big enough leap in itself, and we can go no further than that. That is fine too. The spreadsheet pathway will still allow them to become MTD ready, and we will have solutions to help support you with those clients. What about something different? What about something a little bit more innovative? What about something that requires no data entry for either the client or yourself, seamlessly making MTD submissions quarter after quarter like clockwork? Well, we're working on those solutions too. Now, if you recall, I said we are FCA approved to use live transactional bank data in our applications. We currently use them in Twinfield, but we're always looking at how can we use, we've got access to this data, how can we use this in more interesting ways that add value for our customers and their clients? Or how about if between now and April 23, you educated your most problematic clients in that sector that don't really do anything at the moment, into at least keeping a separate bank account, either for their business or for their property portfolio. And I really think the property portfolio clients are the ones probably most at risk here. We can connect to that data. We can apply algorithms that we've been working on that will automatically categorize those transactions. These algorithms have built-in machine learning capability so that any manual change to categorization feeds in and improves that automatic categorization next time. When we've shown people this prototype functionality that we've been working on, we're often challenged that the transactional bank data alone is not good enough for preparing a true and fair set of accounts. That is absolutely true. I don't think we are submitting quarterly true and fair accounts to HMRC. We are submitting a summary of digital transactions as close to real time as possible using functional compatible software. For me, what's being submitted quarterly is bookkeeping. It's bookkeeping quality data that's being submitted, not full-blown UK GAAP accounts. And I really think there's a place there for bank transactional data for many clients, just for the quarterly updates. The year-end figures, they will absolutely reflect a true and fair view. You will still be going through the same year-end process as far as the accounts are concerned, and it's those final accounts figures that will go into the year-end equivalent of the tax return that we have today. So there's no change from that perspective. We're really just talking about the quarterly updates, because that's going to be the big procedural change for both you and your clients, and we're really trying to explore innovative ways to make that seamless as possible for you. So we're excited about the direction we're headed at Wolters Kluwer as part of our own digital transformation journey, but we also understand that we can't build everything ourselves. We'd never be finished if we did. So every cloud application that we are building, and MTD is no exception, will sit within an API management framework. Now, if you've not heard of APIs before, you don't really know what they are, and I think you're going to start hearing an awful lot about them over the next few years. API actually stands for Application Programming Interface, but really it's just an industry standard way of having separate software applications communicate with each other. We use them extensively already for bringing data into our CCH Central suite, whether that's from Xero, Sage, QuickBooks, or bank feeds. We also use them to allow our cloud applications to send information into our desktop applications. For example, we request digital tax account data from HMRC in one click that uses HMRC's API, and then we send that data into CCH Personal Tax using our own API. Building all our cloud applications within this API management framework opens up huge potential for us to connect to other third-party applications quickly and easily in future. So from an MTD perspective, if your clients are using some kind of cloud property management app to manage their portfolio and they record their income and expenses in there, then chances are we will be able to connect to that application and bring that data in. If you want to value a client's property portfolio or run some CGT what-if calculations, Zoopla has a property valuation API. We could pull that data in and provide real-time portfolio valuations for your clients. There are all kinds of possibilities we can explore with you, and investing the time now to ensure that we have that flexibility around API management in future will guarantee that we're the right technology partner to support your practice in April 23 and beyond. So we're right up against time. Thank you very much for joining me today. I hope I've answered all the questions. If there are any that I missed, then I'll get back to you in due course with those. I hope you found the content useful. If you have any feedback or wish to learn more, then please do get in touch. We'll be running a roundtable event for a limited number of customers who want to share best practice with each other on how to prepare themselves and their clients for April 23. If you wish to be involved in that roundtable discussion, then do look out for the invite that will be coming your way very soon. Thank you once again, and I'll see you next time.